So, have you noticed lately that the generous cashback promos and massive discounts on your favorite e-wallets seem to be, well, vanishing? If you've been wondering why, you're actually witnessing a massive, real-world structural shift in the digital economy. Let's be real. The era of tech companies burning billions in venture capital just to subsidize your daily coffee and rides is effectively over. The standalone e-wallet, the one that used to operate as a heavily subsidized loss leader just to get you in the door, it is fundamentally changed.
Welcome to this explainer. Today, we're dissecting the anatomy of a paradigm shift, the definitive end of the standalone e-wallet. We're going to explore exactly how the back-end architecture of our digital lives evolved from a fragmented battleground of competing promos into highly consolidated, highly profitable embedded finance ecosystems.
All right, here's our roadmap for today. 1. Commoditized payment rails. 2. The digital bank integration. 3. Algorithmic credit as the new margin. And 4. Capturing cross-border revenue. Think about this evolution like a giant puzzle coming together. We're seeing a rapid shift from narrow, specialized super wallets that only really cared about executing payments into massive, diversified everything apps. These apps now bundle messaging, transport, shopping, and crucially, full-scale financial services. It's a whole new ballgame driven by deep integrated ecosystems instead of just standalone features.
Section 1. Commoditized payment rails, the catalyst for change.
So why are basic digital transactions no longer a competitive advantage for tech giants? Well, just look at the stark contrast between the past and present. In the old paradigm, wallets intentionally trapped you in expensive, closed-loop proprietary networks. If you had money in wallet A, paying a merchant who only took wallet B was an absolute nightmare. But today, thanks to aggressive, open ecosystem regulations like Bank Indonesia's BSPI 2030 framework, the market is universally interoperable. Standardized payment rails like QRIS and BI Fast have forced these platforms to completely open up. They've essentially turned the basic act of moving money into a heavily regulated, fully commoditized public utility.
And the sheer scale of this is absolutely staggering. By early 2026, we are looking at 61.7 million active QRIS users interacting with these standardized national rails alongside over 44 million registered merchants. Because of this massive interoperable network, simply offering digital payments, it's literally no longer a technological moat. It's just the baseline expectation now.
To make matters even tighter for the tech companies, these sovereign systems have absolutely crushed the profit margins on basic transfers. Take Indonesia's BI Fast system. By mandating a capped flat fee of just 2,500 rupiah for real-time interbank transfers and often removing merchant fees entirely for small transactions under 500,000 rupiah, the central bank effectively destroyed the old percentage-based revenue model. E-wallets simply can't survive anymore just by moving money from point A to point B. The margins are completely gone.
Section 2. The digital bank integration, the liquidity engine.
Okay, so if you can't make money on the payment itself, how do you survive, right? The answer lies in funneling users directly into the formal banking system through a brilliant concept called zero CAC, or zero customer acquisition cost. Instead of spending millions on marketing to acquire new banking customers, Tier 1 super apps now act as a frictionless funnel. They seamlessly convert their everyday e-wallet users into formal digital bank depositors almost instantly. The super app does all the heavy lifting of user engagement, and the integrated digital bank gets to reap the rewards of a massive captive audience.
And the profits generated by these specific integrations are massive. Cbank, which is deeply integrated with the e-commerce giant ShopeePay, posted an incredible 678.4 billion rupiahs in net profit. Bank Jago, tied into the GoTo ecosystem, saw 276 billion, and Superbank, consolidating with Grab and Ovo, turned its historical losses into a solid 99.7 billion rupiah profit. This right here is the new moat. E-wallets aren't standalone apps anymore. They are literally the front doors to highly profitable, fully licensed digital banks.
Just to really emphasize the sheer scale of this liquidity engine, Cbank alone amassed an astonishing 34.8 trillion rupiah in third-party funds. By making it completely frictionless to move money between your shopping wallet and your bank account, e-wallets have proven to be incredibly powerful deposit-gathering tools.
Section 3. Algorithmic credit, the new margin. Now, once these integrated banks actually have all these deposits, how do they monetize them? Well, they use a modern embedded finance flywheel. Here's how it works. Step 1. Funnel millions of daily users for free.
Step 2. Gather their money into extremely low-cost current account savings accounts, or CASA. Step 3, and honestly, this is where the magic happens. They use the superapp's proprietary behavioral data, like your daily food delivery habits or ride-hailing history, to safely underwrite credit. Finally, Step 4, they lend that low-cost deposit money back out to users as high-margin algorithmic credit.
Make no mistake, lending is for sure the industry's new profit center. Whether it's the seamless buy now, pay later feature embedded directly into your Shopee checkout, or the flexible Pinjaman Atur Sendiri microloans offered to Grab drivers and OVO users based on their earning history, or even a standalone wallet like Dana acquiring Indonesia Arawata Finance to target Tier 2 and Tier 3 multi-finance lending, they're all doing the same thing. They're using your daily e-wallet transactional data to assess your creditworthiness in real time, completely bypassing traditional credit bureaus.
Section 4. Capturing cross-border revenue. The frontier.
So, with domestic payments heavily commoditized, the new frontier for expanding margins is looking beyond borders. In mid-2026, Bank Indonesia and China's PBOC launched a massive cross-border QR linkage, meaning native wallets like OVO and Dana can work seamlessly abroad. But the truly fascinating part, the direct local currency settlement. By settling transactions directly in local currencies like rupiah and renminbi, these ecosystems are completely bypassing traditional Western card networks. This eliminates those pesky intermediary foreign exchange fees and totally disrupts legacy business models.
And this builds into a much larger regional strategy. We're witnessing interconnected real-time payment systems springing up all across Southeast Asia. Features like GrabPay for travel are specifically targeting affluent urban professionals, letting them use a single app to scan local QR codes across different ASEAN nations. Meanwhile, massive central banking initiatives like Project Nexus are aiming to connect instant payments across 5 entire countries. By orchestrating these complex cryptographic settlements quietly in the background, super apps get to retain that lucrative foreign exchange spread for themselves, driving up their margins even further.
To wrap up this explainer, I want to leave you with a thought regarding this massive consolidation of financial power. We've seen how the subsidized e-wallet evolved into a comprehensive digital bank and a data-driven credit underwriter. But as these super apps become the absolute gatekeepers of both national and regional liquidity, we really have to ask ourselves, who truly controls the digital economy when the app that orders your food, underwrites your loans, and holds your life savings is exactly the same entity? Thanks for joining me on this deep dive.